Good afternoon. Peter Klein, Chief Investment Officer, Align Wealth, with you this afternoon, the 25th of January, 2023, after market close. Hoping you guys had a great holiday season, nice start to the new year. I'd like to walk you through some of the slides that we prepared for you today to give you an assessment, to give you a briefing on where and how we're seeing the conditions of the financial markets and how we're navigating those conditions for our clients and the capital we manage and steward for them. Okay, 2022, nowhere to hide. That's the title of the slide and how true it is. As you could see here, except for commodities, every asset class, every sector was down. I mean, there's no other way of putting it. There was really no place to hide. Looking back, however, I like to think that we at Align Wealth did a very good job in stewarding our clients' capital. You may recall we were very early with this non-consensus call at the time of stubborn or sticky inflation rather than the transitory talk that was so pervasive in the early mid part of 21. We felt there were structural changes, and we still do, and a new regime, as we've said, came into play, and we felt that the inflation was going to be around for longer. Clearly, we got that one right. And that led us to a playbook that was decidedly more cautious and one that had a toolbox that was perhaps much wider than we have used in the past. More nuanced, defensive. We had more merger arb plays. We purchased a number of equity positions for our clients' accounts that were below the takeout price, and in many cases they worked in our favor. We were able to get a very good return. I'll call it high single digits in a couple of months with very little risk. We favored value over growth. That's been spot on in a big way. We still feel that way. Utilizing hedges throughout the portfolios to reduce risk and protect capital, spot on. The overweight to energy and commodities was our biggest win. We used structured notes with absolute return profiles to help our clients appreciate, in other words, their portfolio capital increased while the market went down. That was a big one. Of course, overweighting cash, that was the ballast, avoiding fixed income, maintaining and increasing market neutral and hedge funds, all worked in our favor and, of course, in our clients' favor. My wife and I had a chance to visit the Frick Museum last weekend in Manhattan. I urge you to check it out. Extraordinary. And for those who know value investing, Charles Everard and his family had put together a wonderful grant to the Frick of their artwork. This is not one of them, but this is but you know, check it out. The Frick, they're rebuilding their museum on Fifth Avenue, so they're using the old Whitney on 74th, I want to say 75th, and Madison. Extraordinary. Anyway, this is a piece that we came across while browsing around the museum, and it struck me as something that I've been thinking about because since October, we've had a pretty, bullish market, up about 12%. And I'm wondering what the leopard is. Here you see a leopard attacking a bull. And so is the leopard a recession that's due to impact on Fed policy? In other words, are we seeing a recession down the pike that might, be the leopard? Or is it perhaps earnings and operating margins and their impact on the economy and the market? Sticky inflation, stagflation, something that breaks, when you raise the interest rates as much as the Fed has, never, we haven't seen that kind of increase, I don't think, in the last 50 years. Such a short period of time, such a substantial increase to an economy that's over leveraged and addicted to debt. Something might break. We saw crypto, of course, break a bit, and so I wonder. I hope it's not a geopolitical effort because that could be kind of serious as well. But that's in the offing. That's certainly in the mix. So these are the things we're thinking about. From our lens, we see three pathways: a softish landing with inflation moderating, a stubborn inflation with a mild recession, just sort of clipping it. That's our base case. And inflation reasserts itself and significantly impacts margins and earnings. So I guess we'll stay tuned. But the bottom line is that we're allocating our clients' capital to take all three of these pathways into account, overweighting the stagflation one. Now, clearly, the Fed's work of the increasing interest rates I mentioned earlier are having an impact. You see here, they're impacting bank credit, and here they're impacting ISM and PMIs. And you don't often see a contracting PMI without a recession. And clearly, sentiment, here's the NFIB as the National Federation of Independent Businesses, ergo small business, and here again you're seeing still not so great, and so you're seeing this big market move. And I understand that markets typically move before the economy, I get it, but this doesn't sound to be. This still worries me a bit. This worries me a lot because the inversion is a very reliable indicator of a recession, and here you have a pretty substantial inversion. So this tells me that perhaps this recession is more likely than otherwise thought. Stubborn, sticky inflation. This is our base case. This is our likely outcome. And it's got a couple of moving parts, folks. Is a structural issue to it. But any way you look at it, this particular Deutsche Bank comment rings true. Once inflation has risen above 8%, we had that, it takes 2 years for median inflation to fall below 6. Remember, the Fed wants 2. Long way to go. So, and this goes back to 1920, 318 observations. So that has me this is part of the reason why I'm in this sticky inflation camp. The other reason is that this very well may be a different inflation, less of a demand, a supply central inflation like we saw in the 70s, and more of a demand-centric inflation that we're perhaps seeing now. And part of that might be the fact that we have labor whereby folks are, not working but still demanding and still, still inflationary in a way. And so we see this as potentially something that has changed in the landscape that might have implications going down the road. So with all that said, how do we do what we do? How do we manage other people's capital, and in doing so in a way that is consistent with their risk tolerance, their values, and their goals and objectives? Well, again, let me just start off with this one because this is key. We do not subscribe to perhaps the hedge fund model that says all in, all out, we're traders and we're sort of speculators, we think. We're balancers. We're wealth managers. We're dealing with people, that's not numbers, okay? So because of that, we are very mindful of the fact that timing does not work. We're more of a tweaker. We're more of a working the edge. So this particular slide shows you that if you invested $10,000 in the S&P in 1980, it grew to 106 million by the middle of last year, 1.06 million. However, if you missed just 5 of those, I don't know how many days there are, you're down by 38%. Missing 10, you're down 55%. You see what's going here. So you could actually end up missing the days that are the most important because often those days happen after the market falls. And and so you've got, and this speaks to it well here too. After every major bear market, look at the returns you get from trough. from trough, right? So oftentimes sellers sell near trough because they throw the towel and they capitulate. We're done. I can't lose anymore. And that's why we balance the portfolio to prevent the emotionality of getting so disgusted and so frightened that they say throwing it, they capitulate. Because once they capitulate, it likely is the market's going up, and they go up seriously, 99, 95. Look at these numbers, 100. So you have to be cognizant of this, and this is why we always have our favorite positions, our core portfolio, and then we work the edges around that portfolio. Markets are getting a little frothy, we'll pull in a little bit. Markets are being sold indiscriminately and are going down, we'll put some cash to work. That's the way you manage wealth. That's the way you're a good portfolio manager. This is a great slide because it shows me and should show you that the active investor, the stock picker, has a great opportunity right now because there's wide dispersion between the best and the worst performing S&P sector. So if you do the homework, you're an independent thinker, you're always looking for more information, you find an opportunity, ergo energy a year and a half ago, best performing asset sector, and stay away from, say, technology because it's overdone and the multiples are too high to sales, as we've commented up-teen number of times in the last 3 years. By doing that, you could actually bring a lot of opportunity to the bottom line. So this is a stock picker's market. It's going back to fundamentals. The days of momentum and just throwing a dart, I think, are over for now. Stock pickers delight, fundamental analysis delight, opportunities for guys like us. How we are positioned. We're overweight cash. We've got to respect the volatility, guys. Use cash as markets gyrate to remain patient for the best price levels. We've got to have that capital. And the best part is we're getting a return on that cash for the first time in a year and a half. So nice, or years actually. So it's nice to have that cash there. Don't be afraid of it. It's there for a reason. It's a safety valve. It's a ballast, but it's also a font of opportunity from which we could take and allocate and buy some of the best company stocks or investments at low levels, at discounted prices, when everybody else is running scared because they don't have any ballast. We do, and we can take advantage of it. That's called investing. Employ hedges. Now, this is a big win. I had tipped to some clients that have moved in this direction over the years. It's a great idea to have some hedging to protect capital. Fixed income is not the ballast it once was. We've got to be cautious with fixed income. It's getting to a point where it may be starting to get attractive in certain sectors. We're watching for that. Love free cash flow yields, dividend growth. Love the inflation-centric real assets, infrastructure, resources, companies with pricing power. If this inflation call is right, we need to make sure we're investing in companies that are going to be able to raise their prices to combat inflation. And of course, you can't go anywhere at Align Wealth without talking water, pipes, pumps, valves, desal, testing, metering, all good stuff. You've been reading a lot about that, and water has certainly been a winner. We had some good news this week on that too. So here's real assets. You see that with increases in inflation, commodities and infrastructure, real estate, they do well. Energy sector. This is showing you the limited supply response to the price of oil. And because we have not invested into the supply of oil and energy and copper and aluminum, this is why we believe these are going to have a bit of a super cycle-like response going forward. It's a big world out there, and we're thinking that maybe the U.S. dominance in the market for the last up-teen years has come to an end, and maybe we now should open our eyes to bigger gains and bigger opportunities around the world. You could see here these statistics. 84% of the global GDP is produced by countries other than the U.S., but yet 72% of listed stocks are located outside the U.S. Yet, the non-U.S. market has been underperforming substantially the U.S. over the course of the last 15 years. I think it's time to look at ROW, rest of the world. So right, it's not just all U.S. So we've got to think about that. And look, you're buying it cheap. I mean, it's come up a little bit since this, but it's cheap. So I like the MSCI. I like emerging. Selectivity is key. Watching it carefully, inching in over time. That's how you win. And here's again another graph that shows you how cheap Europe is versus the U.S. And you can see here it's over a 30% discount. Okay, finally, a word about comprehensive wealth management. Unless you think we only focus on understanding the capital markets very, very well. That's certainly a good deal of our time. And as Chief Investment Officer of ALINE Wealth, it's a good part of my time as well. But we want you to know that we take planning and we take holistic, comprehensive wealth management very, very seriously at ALINE Wealth. So there's a bit of an equation that we put together that describes what wealth management is, and maybe this is due to my sort of geek days at Bronx Science, but forgive me. But I put this little thing together to remind us what it is. So first thing is investment consulting, the dedication to the science of finance. We talked about that. This is what we do. We put a lot of effort in understanding what's going on in the world of finance, the capital markets. All we do is read and study and roll up our sleeves and go on conference calls and dissect companies and look for the best themes and the best ways to express those themes. It's a big part of what we do. It's not the only part. Advanced planning, all right? So we focus on wealth enhancement, maximizing the cash flow, minimizing the taxes, very tax efficient. Wealth transfer, making sure that all the accounts are properly titled and that the beneficiary papers are on file and everything is set up nicely there. Wealth protection, dealing with insurance and life insurance issues. Of course, charitable planning has been a big focus of ours over the years, building legacies for generations to come. This is a critical piece of a good steward, a good fiduciary, a good wealth manager. You have to be setting up the plan. You know, the old adage rings true. We don't fail to plan. We don't plan to fail. We fail to plan. So planning is a key part of what we do. But again, that's just two of the three-part equation. The third part is us being proactively empathetic, understanding our clients, being there for them, being responsive, being proactive, making sure that they are understanding what we're thinking about, how we're thinking about their portfolio and their plan and the markets, and of course collaborating with their CPAs and attorneys and bankers, serving as a quarterback to allow them to get through that twists and turns of life and get to the promised land, to their golden objectives. So that's from our view, that is wealth management. And thank you for the opportunity. Look forward to further discussions. If there are any questions, if you're looking for more information about our take on things, by all means, feel free to send us an email and I'll get right back to you. Thanks again. Have a great month.